Welcome to our first quarter webinar, The 10 Surprises of 2020. I'm Joe Zidle, Chief Investment Strategist here at Blackstone, and I'm joined by Byron Wien, Vice Chair, and my partner in investment strategy. Welcome, Byron.
Good to be here with you, Joe.
First off, congratulations. It marks the 35th edition of the 10 Surprises. This process starts in August during the annual benchmark lunches, and we begin to formally draft the list of surprises in October. Our goal in the 10 Surprises is not necessarily to get each one right, but we do this instead to stretch our thinking and hopefully challenge yours too. For those of you who would like to download a copy of this presentation, the slides are available for download on the same web page that you'll be watching this webinar. Before we launch into our views on 2020, we're going to do a quick review of last year's surprises. 2019 was a good year for us. Now again, as I said, the goal is not to get all 10 surprises correct. The goal is really to stretch our collective thinking, but nevertheless, we always like to look back and see how we ended up doing. In the first surprise, we thought that a weakening global economy would encourage the Fed to stop raising rates. In fact, the Fed cut rates 3 times in 2019. Secondly, we thought because of no further rate hikes, equities would have a pretty good year. At the time, our view was that the market would go up 15% for the year, and at the time, that was ahead of consensus. We were right directionally, but clearly we didn't go far enough. Number 3, we thought that the traditional drivers of GDP growth, capital spending, and housing would only make modest gains. Housing certainly had a stronger year than we thought, but importantly, we thought that a recession before 2021 was unlikely at the time, and that was pretty far from conventional wisdom. Number 4, we thought gold would fall. Gold clearly had a very strong year. Number 5, we thought the profit outlook for EM would brighten, and we thought that markets such as China and Brazil would lead the way. And they did both, in fact, have pretty good years. Number 6, we thought that the March 29th Brexit deadline would come and go. They missed another deadline later in the year. We did think that there would be a second referendum. Clearly, we didn't get that right. Number 7, we thought the dollar would stabilize. It did for the most part. It was strong against some currencies, but on balance, it was a fairly stable dollar. Number 8, we were incorrect in thinking that the Mueller investigation would result in indictments against members of the Trump organization closest to the president. Number 9, we thought that Congress would get more done in 2019. Clearly, I think it was a more difficult year for legislation. There's still important acts such as the USMCA, which remain outstanding. Number 10, we were correct in thinking that growth would continue to provide leadership. We thought tech and biotech would do very well. So that's a quick summary of the 2019 surprises.
So, Joe, would you say we got 8 right and 2 wrong?
2 were outright wrong. That was gold. And in terms of the rest, I think we had a pretty good year. Directionally, I thought we were pretty right. In some cases, we didn't go far enough, and that would have been on the call on the S&P 500. But generally, I thought it was a pretty good year for us.
Yeah, I think on most of the other 8, we got the essential message right. But there was a part of almost every one of them where we got it wrong.
Well, great. Well, Byron, let's hear about the 2020 surprises.
Okay, let's start out. Number 1. Right now, everybody expects the Fed to sort of stand pat here, not raise or lower rates. We think the economy is going to be weak enough so the Fed is going to lower rates twice and get them down to 1%. That's very much out of the consensus at this point in time. The second one is that we think that younger people are going to play a big role in this election, and that they care about issues that haven't been prominent in the past election. Sure, healthcare is going to be important, but also inequality and climate change are going to be important. And we think that there's a movement in the country toward the left, and we see the Democrats taking the Senate in November. That would be a big surprise. In the third one, we don't see a phase 2 deal with China. The reason for that is that China is not going to give up on its plan to acquire intellectual property from everywhere it needs it. And as a result of that, I think they're going to drag their feet in doing a phase 2 deal. The phase 1 deal was a transactional deal, the Chinese needing pork and soybeans and our being willing to sell them to it. So it was a trade deal, but it didn't involve some of the philosophical issues that are separating the two countries. The fourth surprise would be a big surprise. We think there's going to be a setback in self-driving cars. We think there'll be enough in the way of accidents to really cause the program to be deferred. So as a result of these accidents, a major company is going to drop out of the race toward developing such a vehicle. In the fifth surprise, these surprises got crystallized on December 20th, and there were a few events after that that really impacted number 5. But we think that Iran is now contemplating what retaliation they're going to have for the United States killing a major general in the Iran guards. And so as a result of that, we think that there's a possibility some severe action will be taken. The Straits of Hormuz will be closed, and the price of oil will go above $70 a barrel. In the sixth surprise, we think that the S&P will still move up. When we started work on this, the S&P was at 3,000. We thought it would get to 3,500, and that was a real surprise. But now at 3,200, it's not such a reach. But we still think we're going to have enough market this year, even with all the geopolitical turbulence we're encountering at the beginning of the year. In the seventh surprise, we think some of the tech stocks are going to have a tough time of it. We think the equal-weighted S&P will outperform the market-weighted S&P. We also think that some of the FANG stocks will get into trouble because the government will be investigating them, and it will be different than Microsoft, IBM, and Apple. There were investigations of those companies too, but this time we think there's more popular support and perhaps more pain as a result. Number 8, we think that the United Kingdom will be a winner out of the plan to divorce itself from the European Union, and the UK economy will do better, the market will rise, and the pound will be strong. Number 9, we think the bond bubble is starting to leak, and we think 10-year Treasury yields will work their way up to 2.5%, primarily because of supply and demand. There are 4 big buyers of Treasuries: Federal Reserve, the Social Security Administration, China, and Japan. And we think China and Japan are going to pull back, and the Federal Reserve is not going to be buying a lot of bonds. Finally, number 10, we think the 737 MAX will fly sometime during the year, and that will be an important component of the international air travel industry. Boeing will do well, and airline stocks will do well. So those are the 10 surprises, but we also had a handful of also-rans. Joe, why don't you tell us about those?
Sure. Thanks, Byron. The reasons why we'll have the also-rans are a couple. Number one, these are ideas that maybe we don't have quite the same conviction in as the ones that appear as the 10 surprises of 2020, or they could be ideas where it's an interesting idea, but it's not maybe as big of a market-moving event as some of the other ones that we chose. But nevertheless, every year there are a handful of these also-rans, so I'll go through them quickly. First is that the fears of an economic crisis in India ameliorate. We don't think EM on balance is going to have the best year. We think there are going to be pockets of strength out there, and India is one. We think they recover from decelerating growth. We think that Modi's business-friendly policies continue, and the economy grows at 6%, and the market rises 20%. Number 12, we think artificial intelligence begins to be viewed as a paper tiger. This could end up looking something like the Y2K bug, where everybody projected their biggest fears into Y2K 20 years ago. We see people doing the same with AI and the job apocalypse. Manufacturing jobs have already been automated, but we think it proves harder to eliminate the service jobs. Number 13, economic problems in Russia intensify, even though the price of oil rises. We think that Putin is going to work on his relationship with China in order to maintain relevancy on the world stage. We think that China and Russia appear prepared to face off against Europe and the United States. Number 14 is about populism and inward thinking. We think they continue to spread globally, particularly in emerging markets. The disharmony, we think, will continue to spread throughout the world. We think it will end up creating turbulence in financial markets everywhere. And in EM, we think investors are going to end up turning away from the local currency debt, which forces spreads higher. Then lastly, North Korea, we think, will agree to suspend its nuclear development program after a meeting with President Trump. It doesn't give up its existing stockpile, but nevertheless, we think that North Korea will be basically defined as, call it a threat, but not necessarily an imminent danger. So those are the also-rans of 2020. And Byron, let's turn to a few of the slides. And the first one that we'll maybe hit on is the asset allocation. Why don't you take us through that?
Okay, no changes for the fourth quarter. Just to review where we are, we think you should have 5% in global multinationals, 10% in U.S., 5% in Europe, slowing growth there, 10% in the emerging markets. We still think there are opportunities there, 5% in Japan. And then 30%, that's 35% long only, 30% in alternatives, 10% each in hedge funds, private equity, real estate, nothing in gold, natural resources, 5% directly. And here's the radical part of it, 15% in mortgages, non-conventional high yield, mezzanine financing, leverage loans, some emerging market debt, and 15% in cash to take advantage of opportunities.
It's worth pointing out that cash component, that 15%, is the highest since the radical asset allocation was launched.
Okay, so for individual investors rather than institutional, we would put municipal bonds in the fixed income category. For individuals, we're high on municipal bonds. This is the Ned Davis crowd sentiment chart, a chart which we believe is the best measure of sentiment out there, because it not only has opinions calling up people, asking them what they think, but it also has transactional data like put-call ratios and other material. And you can see here we were in pretty optimistic territory at year end, but that I think has been quickly reversed by the assassination of Major General Soleimani. So my belief is that the market has some upside here, probably no more than 10%, but it is not cheap. We're into optimistic territory, but we're not as extreme as we have been at earlier times.
And this table looks at what we call our recession checklist monitor. And this is something that we'd put together a couple quarters ago, earlier in 2019, to help us to understand where we are with respect to the cycle. And I won't spend too much time here, but what I want to highlight is the top portion of the table, which are what we call primary indicators. These are the ones that are historically kind of most closely associated with being able to call the turning point in an economic cycle. And historically, it doesn't necessarily take more than one of these to flash a warning in order to indicate that a recession might be on the horizon. But as you can see, 2 out of the 3 have flashed warnings over the course of the last 12 months. And that are the leading economic indicators that had rolled over. And LEIs are barely growing at about 0.1% right now. And then secondly, we did have an inversion of the yield curve in the mid part of 2019. So both those tell us that there's potentially a recession out there on the horizon. As you heard from our 10 surprises earlier, we think a recession in 2020 will be avoided. But nevertheless, it tells us that it is a later cycle environment. And as a result, we need to be a little bit more cautious. The bottom portion of the table are, kind of what we call necessary preconditions. These are things like euphoric investor sentiment, as Byron just alluded to. We're sort of in an overbought situation. Consumer confidence needs to roll over. The unemployment rate historically has to be rising, which it is not currently. And corporate earnings historically are in a profits recession when you get an economic recession. Corporate profits growth was pretty flat for most of 2019, but we might have barely avoided a profits recession. So overall, it tells us conditions out there are such that we want to be more cautious.
Joe, I just want to throw my view in here. I have a somewhat different opinion than you do about the inversion of the yield curve. It was inverted only briefly, and it was inverted for an unusual reason. The yield curve inverted because the intermediate end went below the short end. Usually it inverts because short-term rates rise above long-term rates. That isn't what happened when it inverted last August. So my view is the difference in inversion and the short period that it was inverted makes it not as severe a warning signal as it has been in the past.
Well, it's been a subject of a lot of debate between you and me. I thought you would say that, so we have a chart a little bit later that I'm going to highlight. And by the way, that chart was one where you did argue that it ought to be removed, but somehow it found its way through your desk and through compliance. So we'll talk about that in a little bit. I want to go through a couple economic charts really quickly. And the first is looking at labor markets, right? And this really does support the argument that we're not on the precipice of a recession. Labor markets remain pretty strong overall. The pros, you can see them on the left-hand side. It's that the participation rate's increasing and the unemployment rate's the lowest it's been in 50 years. The right side of the chart is one that tells you that these are kind of leading indicators of the employment markets, right? It's looking at the growth in temporary employment. Temporary employment's rolled over; it's declining. And secondly, the number of job openings has started to fall. And you can see it's fallen at a rate greater than, or fallen to a level lower than the earlier mini recessions that we faced over the course of this cycle. Nevertheless, consumers are saving, right? We see the personal savings rate remains elevated, and debt payments as a percent of disposable personal income, still remains very, very low by historic standards. It suggests that the consumer's not anywhere near in trouble. And this chart on housing suggests that single-family home permits suggest that housing markets are going to continue to rise. We saw that in the second half of 2019 with stronger housing markets. Single home permits actually are pretty significant for economic growth because new home construction does add a lot more to GDP than, say, like existing home sales. So it's a relatively bullish sign on housing markets. CapEx, that continues to be one of the weakest parts of the U.S. economy. It was sort of driven by this manufacturing recession caused by trade, and we see that spending and intention for future spending plans continues to decline. So we have an economy that's clearly not hitting on all cylinders. It's one that is relying on the consumer, and so we'll see how that continues to unfold. Now, turning to U.S. equities, Byron, I'll maybe let you comment on the earnings.
Okay. Well, you can see here that the estimates of analysts are that S&P earnings are going to be up close to 10% this year. We think that's too ambitious. Right at the beginning of the year, they're usually as high as they get during the year, and we think 5% is a better number. This is our dividend discount model, and the purpose of this is to really give you some tools to think about whether the market is fairly valued or not. If you know two variables, I can tell you what the equilibrium point is where bonds and stocks are equally attractive. What you have to know is what the S&P is going to earn, and you have to know where the 10-year Treasury is. So we've been debating between 172 and 174 for S&P earnings for this year. And if you look across the 2% line, which is the 10-year Treasury is 180 right now. So that would give you an equilibrium point of somewhere around 3,300. And the market is below that right now. But there's not a lot of upside. Now, of course, when the market opens each day, doesn't know I have this model in my handout. So it doesn't always trade right on this number. But what this is saying is that the market is roughly fairly valued. Usually before the end of the cycle, it gets overvalued. It isn't overvalued yet. But if rates rise, this market is very sensitive to interest rates. And if rates rise, let's say they go to 2.5%, then the equilibrium point drops to something like 2,600. So watch the bond market. That'll give you an indication of what kind of trouble or joy we're going to have in the stock market.
And one of our surprises is that the equal-weighted S&P 500 is going to outperform the cap-weighted S&P. And what we've seen over the course of this bull market has really been a concentration among tech stocks. In 2019, we saw the highest concentration of tech stocks that we had seen basically since the tech bubble in the late 90s, and prior to that, the late 1960s, where you had the Nifty 50. And basically, what you had was the top 10 stocks making up almost 23% of the S&P 500. What this chart looks at is the S&P equal weighted, less cap weighted, and you can see that the equal weighted index is a lot less expensive, and you can see that on the bottom clip of this chart. So we do think that almost every other stock other than FANG is probably pretty reasonably priced, and so we think there'll be an opportunity for other sectors in 2020. This next chart highlights the idea that investors may eventually determine there are no alternatives, right? And what this chart shows is S&P 500 buyback and dividend yield versus the 10-year Treasury being a lot higher. And in fact, on the right-hand side of this chart, you can see that the dividend yield of the S&P is higher than that of 2-year Treasury. It's a pretty unusual case, as you can see. And about 46% of the stocks in the S&P 500 actually have a dividend yield higher than the 10-year Treasury. So investors might finally start to turn more confident on equities. We've seen record outflows from equity markets, but they may determine that this is the only place where they're going to find yield, and that is one of those factors that could, at least temporarily, push the markets up higher. Now, the question becomes, what's the long-term profile look like for the S&P 500? And I think this is an interesting scatter plot here, and there's a lot going on, but really what it looks at is on the vertical axis, the annualized 10-year return of the S&P 500, and on the horizontal axis, the PE ratio. And what it highlights is, 10-year annualized returns given various different valuation starting points. And today we're trading at about 18 or 19 times earnings. And given that as a starting point, it argues that the next 10 years for the S&P, stocks might only return 5% per annum. And that also fits with a longer-term question that you and I have pondered, Byron. And maybe we could share with people sort of your expectation for the next decade, sort of putting this chart aside for a second.
Yeah, well, the chart vindicates what my opinion is. Growth in the U.S. is going to, over the next decade, is going to be about 2%. 1% from population, 1% from productivity. That's real growth. Inflation will be about 2%. So that takes us to 4. Buybacks and other chicanery will take us to 5. And that's the number you've got here. So I would say that our view is the next decade is going to be a 5% year for annual return for equities. And that's very different from the past decade.
Let's look at a couple charts now on the economy, monetary policy, and first we'll start with inflation. I think this is a chart that we want to keep an eye on in 2020. And what this looks at is the wage growth differential, right? That between your average hourly earnings, right? So you're looking at your production and non-supervisory employees versus call it your white collar workers or your salary type employees. So when you look at average hourly earnings, it's basically a combination of all wage earners, but over 80% of those wage earners are hourly. They're called production and non-supervisory employees. And their earnings have been growing at a rate now that's hitting about 3.7% per annum. And it's the highest it's been since basically in the last decade, since 2008. And what this chart looks at is the difference between those hourly production and non-supervisory employees in all employees. And what you can see is it's really one of the biggest differences that we've seen in over 10 years. What it suggests is that the lowest wage earners are experiencing the fastest earnings growth. It's good for consumption. They have a propensity to spend, but it also talks about some of the underlying inflationary pressures that could begin to emerge in 2020. Wage inflation ends up being a pretty big component of inflation. It becomes a pretty big driver. What this chart looks at is CPI as well as core. And you can see the headline measure of CPI is still relatively muted. When you look at core, however, which is stripping away the more volatile components of CPI, you can see a pretty solid uptrend. So I think there is an inflationary story here. Now, what the chart on the right-hand side attempts to do is break CPI down into what's called sticky core CPI. And that is basically a measure of the components of CPI that don't really change all that quickly. So the non-sticky part of CPI would be things like gas prices, right? Fuel, it's pretty volatile, changes month to month. The sticky side of core CPI are those things that don't move as much, things like home prices, things like medical care, services. And what they're showing you is that inflationary pressures out there in the economy are building. And now let's turn to the global growth outlook.
Okay, as you can see here on the left-hand side, almost everybody is growing. And as a result of that, we believe that it's going to be a positive year for equities. On the other hand, the growth in almost every place is declining. The United States, the red line is 2019, the blue line is 2020, and in every case, just about it's either zero or a decline. Zero in the US, zero in the developed markets, but decline for the whole world and the emerging markets. On the other hand, in the case of China, it's a more serious decline compared to 2019. So growth around the world, but slowing growth. And one of the reasons for it is manufacturing. There's some hope in manufacturing PMIs, but industrial production is trending down. That really needs to reverse if we're going to have a strong economy. So we're pretty comfortable with the idea that growth is going to slow, but there's going to be no recession.
And this chart looks at central bank balance sheets. And as you can see, 2019, we saw a pretty massive reversal from shrinking central bank balance sheets back to expanding. We saw central banks all around the world cut rates. And on the lower right-hand side, you can see that 87% of central banks' last move was to cut, and that was the highest that we had seen since the Great Financial Crisis. I once had a boss who told me that if you had a problem that could be solved with money, then it's not a problem anymore. I've employed that in my personal life, and it looks like that's the same strategy central bankers are taking. Again, it's one of the reasons why we've been able to avoid a recession despite a manufacturing-led pullback. Now to look at global debt markets for a minute. First thing that we would point out here is that nearly half of the investment grade universe is the lowest quality. That's a BBB rating. And one of the risks here is that as growth slows, because we do think growth will continue to slow, we could see some downgrades. It's the weakest or the lowest quality investment grade index that we've seen in its history. In other words, it's got the highest percentage of BBB rated bonds. And we think some of those are at risk of being downgraded, which could flood the high yield bond indices. This chart looks at global debt levels. Debt's increased all across major economies and countries since the Great Financial Crisis. You can look at economies or countries such as Korea, the United States, China, Canada, Hong Kong, Japan. And what we show in the column is each country or economy's breakdown of government versus household or non-financial corporate debt. The other interesting thing that we highlight in this chart is where each country or economy's debt was at the start of the Great Financial Crisis. About a decade ago, the total amount of debt around the world was about $180 trillion. Today, it's $255 trillion. One of the concerns that we have is the law of diminishing returns, that the amount of bang for the buck is going to continue to decrease as countries increase the amount of debt outstanding. And what you can see here is the amount of negative yielding debt. It has declined since the mid part of 2019, where today about 33% of the debt outside the U.S. is a negative yield. And one of the risks here is that as we do get more inflationary pressure, as we get the 10-year Treasury yield moving higher from here, which we think will be the case, we could see more and more of the negative debt evaporating. In other words, we could see a move back to more normalized rate levels. We don't think Japan is going to take itself out of negative yielding debt, but maybe some of the negative yielding debt in the euro area starts to move back to zero or maybe even positive yield. And that runs the risk of creating losses for investors. We could see losses in investor portfolios on their quote unquote safe money in ways that investors haven't seen in generations. It's been 40 years since we've seen a secular bear market in bonds. And if the amount of negative yielding debt continues to fall, then we will see investors taking a lot of losses on the quote unquote safe portion of their portfolio. I think that could be a risk. And we'll focus on risks to the outlook with this chart as well. And Byron, this is the one that I wanted to talk about earlier. Yeah. And I think what I heard you say earlier, if I'm to maybe boil it down to just a few words, you might have said something like, this time is different. Not to put words in your mouth, Byron.
Those are the four most costly words in money management.
So what this chart highlights is the yield curve. And one of the points that Byron and I have debated a lot since August when we did see the inversion of the 10s, 2s was the exact significance of it, right? And Byron's point is that the curve did invert in a rather unusual way this time around. And I think that's a fair point. Now, a lot of people who did dismiss the value of the yield curve as an indicator were very quick to point out that the curve re-steepened, it de-inverted. And what this chart highlights is that it's not unusual for the curve to be positively sloped at the time when a recession begins. Remember, the curve provides a warning. On average, it's about 22 months from when the curve inverts until a recession begins. Equities don't have nearly the same track record. In fact, the S&P 500 will historically only peak about 6 months before a recession begins. The yield curve is the clearest, and it's also one of the earliest warnings that you're going to get. But what the chart here highlights is that normally the curve has, I don't want to say normally, but the curve has re-steepened and it has been upwardly sloped at a time a recession begins. So I'm a little bit more reluctant to sound the all clear, but nevertheless, it's one that Byron and I spend a lot of time debating, and I'm sure it's something we'll continue to focus on. What this chart highlights is that the growth rate of exports has been negative for 2 consecutive quarters. I've put a lot of emphasis on the risk of a manufacturing recession spreading to the broader economy. I think most analysts have gotten trade wrong, where they've looked at it a little bit too simplistically and haven't considered second and third order effects. We have a global economy that's more or less grown up on the notion of free trade and the benefits of globalization, and that's something that is under attack virtually in all corners of the world. It's not just the U.S. versus China, it's Japan versus South Korea, the U.S. versus Europe, and more. And I think one of the concerns for me continues to be that growth in international trade continues to decline. As you heard from earlier, one of our views is that the U.S. and China will not arrive at a phase 2 deal, and we think there will be balkanization of trade, a balkanization of technology, and I think those things will be negative for the global environment.
Here's the situation with operating margins. They're declining, and that's one of the reasons why I believe that the current estimate of 10% earnings growth for the S&P 500 is going to be declining from the present level. Analysts are looking for 10%. I think that when the tally is done at year end, it'll be closer to 5%, and the reason for it will be shrinking margins.
Let's also look at some of the long-term considerations, Byron.
Okay, well, these are a few charts I forced into the presentation.
We all have a few charts that we forced into the presentation.
Okay, one of them is I want everybody to understand that China is approaching us in terms of how much money they're spending on R&D, and they're going to cross us very soon. And both the U.S. and China use government money to finance R&D, but both are declining. And so it's the private sector that really is important here. The U.S. is spending a fair amount in the private sector on R&D, but China is spending more. So I'm worried that China is going to pass us by in innovation, and that's going to be a real surprise at some point. And the U.S. is a high-cost producer, and if we can't continue to innovate, we're going to be in trouble. So that's one issue I want everybody to be aware of. The second is the inequality issue. If you have a good education, the chances are you're going to have significant assets. This shows the sharp difference between those who have a college education and those who don't, and also between the white population and the minority population. And right now, the white population, which represents 60% of the total population, has 84% of the wealth. And 16% of the wealth is in Black, Hispanic, and other. Over the next decade, the Black, Hispanic, and other population is going to be rising. And it won't be long before it's 50-50. The issue of inequality is very important politically. We're probably only at the beginning of that now, but over the next decade, it's going to become more important. And finally, on climate change, it isn't a clear and present danger in most people's minds, but it is in reality. And it depends on who you are. If you're all U.S. adults, here you can see that about 20% don't believe it's CO2 and human activity that has contributed to climate change. But if you're a Democrat, you're more likely to think human beings are responsible for it. If you're an independent, you believe that also, but not as severely. And if you're a Republican, you're less likely to believe it. But if you look at the chart on the right-hand side, you can see that the global temperatures have been rising. And you can say, oh, it's only a half a degree or 1 degree Celsius. How important can that be? Just look at what's happening in weather patterns and to the glaciers in the Arctic and what's happening to sea levels rising. If you don't think this is going to be a very important factor in our lives going forward, you're not paying attention to the data.
Well, at this point, Byron, we did receive a number of questions that people had submitted in advance. So why don't we turn to those questions? And the first one, I'll just read these aloud. The first one is, which of the 10 surprises of 2020 do you think is most out of consensus and why? So I might turn to you for a thought, and then I also have one as well.
I think most people think it's very unlikely that the Fed is going to be reducing interest rates. I think that's very, I would pick that one out. What's your thought?
My thought is that the bond bubble beginning to deflate. We think that the 10-year Treasury yield could hit 2.5% and the yield curve could steepen. I think most people continue to see the 10-year Treasury yield pretty contained. And I think a couple of the areas or the reasons why I think it will be a bigger surprise is, number one, people continue to not believe that we will see inflation. And I think all the components, whether you're looking at CPI and the sticky parts of CPI, are there for inflation. And we see it also in home prices and things like that. But the second issue is one you alluded to, and that's the supply demand. There are, just 4 big buyers of treasuries, and it's pretty clear that Social Security, for instance, won't be buying anymore given that they're swinging to a deficit. And China and Japan have already curtailed their purchase of treasuries, and I think that could create some upward risk there. The second question is, will the consumer continue to drive GDP growth in the coming year, or is consumer sentiment becoming a risk to the economy? I actually think that it is becoming a risk to the economy in the following. We don't have too many other parts of the economy that are sort of, kind of firing right now. We know that CapEx is declining. We know that CapEx is really a derivative of CEO confidence, and CEO confidence has basically come off its highs of 2018. And so I think there's very few other kind of options for the U.S. economy other than to just turn to the consumer. And I think a concentrated leadership, in my opinion, is always the weakest type of leadership. So I think because people are relying so much on the consumer, it does become a risk. But Byron, what do you think?
Well, I think it ties in with number 3. So why don't we hit that one? You can see if we go to war with Iran, I think the consumer is going to pull back his or her spending. So I think geopolitics is going to play a bigger role this year as a result of the actions that were taken last Thursday. We can go on number 4 on U.S.-China trade relations. I think we see a tendency toward decoupling. We don't think that's going to get better. We think it could get worse. What's your opinion, Joe?
I agree with you, and I think decoupling, or call it the regionalization of trade or the deglobalization of trade, I do think it is a bigger risk than most people are acknowledging, even at this point. And I think one of the things that we've got to consider is this is a global economy that since the mid-1940s, since the agreement at Bretton Woods, it's a global economy that was really predicated on 3 things. Number 1, the benefits of free trade. Number 2, currency stability. And number 3, lower tariffs. And all 3 of those have come under question in the last few years, not just as a result of the trade war between the U.S. and China, but we've seen it in terms of regionalism, nationalism, populism, and everything else around the world. And so I do think that will cause a reorientation of supply chains. There will be some winners in that, but I think that whole reorientation of the supply chains, the reconfiguration of it, are going to create volatility, and volatility ends up being the enemy of growth.
Look, I think the world is a codependent place, and the 1 and 2 economies, U.S. and China, should be cooperating, not conflicting. And so I don't think this is good news.
The next question is, more central banks eased in 2019 than any year since the great financial crisis. Where do you think monetary policy goes next year? Or I should say, where do you think monetary policy goes this year?
Well, if we're in danger of a recession, I think monetary policy is going to continue to be easy. And I also think we're willing to use fiscal policy because the general belief is deficits don't matter. So my view is the 2 tools that the government could use, easing monetary policy and spending money at the fiscal level, are probably going to continue.
Yeah, and I think we have to be concerned about the law of diminishing returns. Simply, you're going to get more bang for your buck, when you take your debt, from $1 trillion to $2 trillion, than you will when you take it from $22 trillion to $23 trillion. And $255 trillion of global debt out there already. What's the next 1, 2, 3, or 5 trillion going to produce in terms of growth? Well, we know you can do sensitivity analysis. You're simply going to get lower and lower growth for every dollar of debt that you put into the system at this point. So I think the concern is, what's next, that we've already spent a lot of those bullets. Last one, Byron, maybe a fun one for you to end on. Tell us about the process. How do you come up with the 10 surprises each year?
Well, Joe, I think you said it best at the morning meetings today. How do you come up with the 10 surprises? I take a shirt cardboard, and sometime in October, I think about all the things that could happen in the following year, and I wrote them down. I think I wrote down a dozen of them, and I handed it over to you, and I said, Joe, here are the 10 surprises. Here are my ideas. You can change any one you want, add anything you want to add, and come back to me in December, and we'll decide on how we're going to go. And what happened after that?
I think I'll fill in the rest of the story for everybody listening. So Byron hands me the 10 surprises, or maybe 12 at that point, that were roughed out, and said, I don't want to see them again until they're published. I said, great. About 2 days later, you said, Joe, how are the 10 surprises coming along? And I said, great. And then you said something like, well, maybe we should start meeting on these on a weekly basis.
Anyway, a lot of work goes into these 10 surprises, a lot of arguments back and forth, a lot of disagreements. We've given you the list. That's the best we can come up with, and we'll see how the year works out.
Thank you, Byron, and thanks again for everyone who tuned in with us today. In closing, I'd like to remind everyone that our next webinar will be on April 9th, 2020. And lastly, If there were questions we didn't get to, or if there are other concerns or feedback, please let us know at blackstonestrategy@blackstone.com.